Hey everyone, welcome back to CapEx Investors Real Estate Investing Educational Series. Today we're going to talk about multifamily classifications and your investment strategies. So let's get at it. There are four different types of classifications for the multifamily sector. The first one being the A-class property. Now, these are known as your resort-like or resort-type properties, which means that they have lots of amenities. You could find these types of properties in high rises. Generally, they're very expensive in rents, and that's because they're very appealing to the upper class. You'll see that these properties will have amenities such as pools, jacuzzis. Sometimes they'll have restaurants and valet service as well. They'll have gyms to exercise in. In addition to that, they will be located in affluent areas as well. B-class properties have some of the same amenities, except they're not as resort-like as your A-type properties, meaning that they'll have some amenities like a gym, they'll have a pool, maybe a jacuzzi, and they're newer type of properties also located in more affluent areas as well. C-class properties, now these are the box type properties that you see pretty much everywhere, right? They don't have really a lot of amenities, if any at all. You'll see these properties, they won't have a pool, they won't have a gym, valet service, or any other type of amenities. You can also find C-class properties in affluent areas. For example, you can find a C-class property in Beverly Hills, which is a very affluent area of Los Angeles. Now, D-class properties are pretty much the same as a C-class property, meaning that they're a box. They don't have a lot of amenities, if any at all, but they're in much worse condition. Generally, these properties have a tendency to be much older. They were built in the beginning of the 19th or the 20th century. These properties, they're great investments because you can buy these properties, you can remodel them or rehab them, and you can increase the rents to market. Now, so how are these correlated with socioeconomic status? Well, it goes hand in hand, right? So if you have an A-type property, it's going to carry a much higher rent than your B, C, or D class properties, which means that you have a higher income earning tenant that will rent that unit. Whereas B properties, they're catering to your professional tenants. However, these are professional tenants that maybe starting out don't necessarily need to have the resort-like type of amenities. Your C-class property usually house your blue collar workers. However, again, I'll go back to that example of having a C-class property in an A-class area or market such as Beverly Hills, which then would cater to higher income earning tenants as well. And then your D class properties are usually found in economically depressed areas of the city with higher crime and deferred maintenance issues. So what are the different types of investment strategies? Well, let's see. There is your core investment, which your core investment refers to your asset class properties in desirable areas. There is also your core plus investments, which refers to stabilized properties with reliable tenants and low risk profiles. Then there's your value add properties. These have generally slightly higher risk in the investment, but offer a lot more growth opportunities than the other two properties, meaning that you will be able to recapture your investment in a shorter amount of time than you would on your core investments, your core plus type investments. Then there is the last one, which is the opportunistic real estate investment. Now, this one generally is a property that's vacant, that's been vacant for a while and boarded up and needs to be completely rehabbed. It also refers to ground up and construction for multifamily. And in reality, most of these two types of properties have low or non-existent cash flow. So what are the most important factors to consider when evaluating a multifamily investment? Well, you should look at what kind of desired return on that investment you would like to have. That'll help you choose the kind of class of properties that you want to invest in. Metrics such as the cap rate, the cash on cash return, the internal rate of return, and also the equity multiple. The most important part is the multifamily market in which that you decide to invest in. This is also something that you need to consider because it should be driven by data analysis, meaning like what is the population growth over time? What is the crime rate over time? Other things such as what is the earnings capacity of the population in the immediate area year over year? So these are factors that need to be considered, and you should never rely on your intuition or a hunch on that particular market. So if you'd like to learn more about investing in the multifamily sector and earning passive income, and maybe you'd like to sit down and just go over your goals with us, we'd like to go ahead and try us out. Give us a call at 310-496-4900. You can email me directly at diego@cbancorp.com, or you can check us out on the web at www.capexinvestor.com. So I want to thank you for watching this video, and I look forward to seeing you on the road to financial freedom.